Hello, welcome back. This is the part 3 of the AF3111 week 3 on lessees accounting. Just before the short break, in part 2, we've looked at the accounting model, single accounting model for the lessees. And we know that we've just learned the double entry. There were 3 of them. And in order to work out the lease liability figure at the inception date or commencement date of the lease contract, we need to work out the present value of the lease payments. Okay, and we've also looked at the interest rate that we use to discount future cash flows, which is all your payments of the lease terms, lease payments, and then we've looked at the meaning of different meanings within the figures of lease payments as well, such as variable lease payments, RVG, etc., etc. Okay, in this part, we're going to look at what happened for the lessees after we have recognized right of use of asset and lease payment. And during the lease term, how do we account for the change of the lease liability as well as the change of the lease right of use of assets over the lease term? And after that, shortly after that, we would have 2 examples, okay, to go through the concepts. Let's move on. So shortly after the commencement of the lease term, right, the lessee will recognize the lease liability as well as the right of use of asset. Both items would change its values over the lease term. So we're going to look at subsequent measurement first. And the first item we're going to look at would be lease liability. So after the commencement date, lessee shall measure the lease liability by A, increasing the book value of the lease liability carrying amount to reflect interest expense on the lease liability, just like as if you have a financial liability over the term of the lease. The lease liability figure would then change, right? It would then be increased by the interest expense, just like a balance payable, for instance. And then B, it would be reduced by the lease payments made. Okay, so it's quite similar to bonds payable, in fact. And C, remeasure the book value to reflect any reassessment may be due to the factor of variable lease payments, which will be covered in week 5, or due to lease modifications, which we won't cover at all because of the scope of the syllabus. Unless reassessment, otherwise the total finance charge, or more easy understand terms, interest expenses over the lease term would be equal to the total lease payments minus the initial value of your lease liability. That would be equal to your total interest expense. Now, this concept is not new to you. In fact, when you were looking at the bonds payable total interest calculation, it is the same, right? Total payments minus the initial value of your bonds payable, same concept. And interest expenses would then be allocated to the profit and loss by applying the same discount rate used at the beginning of the payment period to the outstanding lease liability. So the outstanding lease liability, which means at the beginning of the term of the year, then you have the balance of your lease liability, you multiply by the discount rate, then you will be able to work out interest expense. And this approach is in fact exactly the same as amortized cost method that we have learned back in week 1 of IA2, right? Bonds payable. Okay, other than the lease liability, we also have the right of use of asset. This right of use of asset is like a normal asset, like for instance, it could be a PPE. It would be in fact depreciated, but instead of using the term depreciated, we use the term amortized. It's the same thing. On the straight line basis over the shorter of its useful life of the right of use of asset as well as the lease term. Okay, so it would be the shorter of the two. And the depreciation of the right of use of asset to reflect the use of this asset will be recognized in a manner consistent with a non-current asset, and that's a measure at cost or fair value, depending on whether this right of use of asset satisfy the definitions of PPE or IP. It could be, in the case of PPE, cost and reval model, or IP cases, it could be cost model, right, in the Hong Kong AS40, right? Of course, IP also have what fair value models. Okay, right. Now, let's determine the terms here for the particularly the denominator. Right, we know that depreciation normally would be calculated based on the book value of the asset, the original values when we first recognize it, and then in here for depreciation on the right of use of asset, it will be at the shorter of lease term and the useful life of the right of use of asset. Okay, so it will be shorter of the two. Very likely, in most of the case, will be just the lease term, because lease term tend to be shorter than the useful life. However, under two specific circumstances, in fact, we were decided to dividing this right of use of asset by the useful life. And the situations will be two of them. One is, in fact, there is a purchase options allowing the lessee to buy the asset at the end of the lease term, and it is reasonably certain that that would be done so. Or if, in fact, the lease contract would transfer the ownership of that asset to the lessee by the end of the lease term. Under both circumstances, any one of those, in fact, the denominator should be useful life instead. And then the book value would then be used to minus the residual value of the asset at the end of the useful life. Now notice that the reasons we divided that by the useful life is because we believe it based on our best estimation at the inception date that it is reasonably certain that the lessee would buy the asset. So as the lessee would use the asset more than the lease term, and if the legal title of the asset would be transferred, ownership would be transferred to the lessee by the end of lease term, that means the lessee can use the asset again more than lease term until the useful life, and that is why we divide by useful life. And residual value has to be the end of the useful life residual value. Okay, and lessee's right of use of assets would be also eligible for impairment test as well, subject to Hong Kong AS36. Okay, right then, let's have a look of two examples, right? And hopefully you will be able to understand how to account for lessees, okay, during the terms of the lease. Okay, requirement: prepare journal entries to record the lease for 5 years. H enters into a 5-year lease of equipment with title transfer to H at the end of the lease term. That means at the end of 5 years, the title, the ownership of the asset will be transferred to H at the end of the lease term. H agrees to make 10,000 on the commencement day and the following annual payments at the end of each year: 10,000 year 1, 12,000 year 2, 14,000 year 3, 10,000 in year 4 and 5 respectively. Okay, so basically we were told that in fact that would be the following payments, as you can see here, right? And before we move on to read the rest of the information, let's determine two important elements within the questions in order to determine the lease liability as well as the useful life, or if you like, a denominator, to work out depreciation for the right of use of assets. Number one, okay, lease term. How many years in this case? Well, we know that it would be 5 years because we only have a primary period. There is no secondary period, as H, the lessee, would be eligible to receive the ownership of this asset after year 5, as you can see in these questions. Right, so lease term 5 years. How about lease payments? Well, lease payment would be those payments that are either fixed payments, variable payments, option to buy the assets, RVG, residual value guarantee. But in this question, we only have fixed rental, we don't have variable payments, we don't have purchase options, okay, and we don't have RVG either. Okay, so in other words, it's relatively straightforward. It is clear that we can only consider the following items, the items that are highlighted in red as the what? These payments. How about the first 10K that we pay on time T0 at the commencement day? Of course, it should be excluded from the lease payment calculation. Remember, lease payment calculation is used to work out lease liability, but the first payment was already paid, therefore it does not have an impact on the liability figures. Alright? Okay, so two numbers, two information were there, 5 years lease term, and then the numbers in red are in fact their lease payments. Okay, then we were told that as an incentive to H for entering into the lease, lessor agrees to reimburse to H the commissions of $500. So H would receive an lease incentive from the lessor equal to $500. Okay, H uses its incremental borrowing rate, the rate is given for you, to work out the discount, the lease payments, and H determines the right of use of asset will be depreciated on a straight line basis using the cost method over the useful life of 7 years from the commencement day. In fact, we don't have to tell you it is 7 years. But I have to, sorry, we have to tell you because the question did not mention, right? So this is important. We would use 7 years instead of 5 years to work out the depreciation because ownership was transferred. Okay, let's start it with the usual calculations. Let's determine the lease liability at the inception day or commencement day, which will be equal to the present value of the 5 numbers here, 10K, 12K, 14K, 10, 10, and they will be discounted using the incremental borrowing rate, 4.235%. That gives you 49,599. That would be the lease liability figure to be beginning with. Okay. Now at the inception date, what we do then is we will credit lease liability equal to this number as we've just worked out. And because we pay 10K on that same day, we credit the bank 10K. The sum of the two together would then be debit right of use assets. Now, if you are following the way I suggested in the slides previously, in fact, the payment that you pay on the first day can be done like this by debiting right of use of asset 10 and then credit bank 10, and then do another pair of entry, credit lease liability, debit right of use of asset. That's fine as well. Okay, it's up to you. But then the lease incentive that you receive at the beginning of the year 1, which means T0, it would be debit bank, right? $500 money received from the lessor and then credit right of use of asset. Now, before we continue, right, let's summarize the initial value of the right of use of assets. It should be equal to the 49,599, which is this lease liability figures, plus the 10,000, altogether 59,599, which is this number, minus 500, the second entry, credit right of use of asset. So the starting number value of your right of use of asset at the commencement date should be 59,099. Now make sure you know it, because that's seriously affecting your depreciation calculations later on. Okay, so we did the entry at T0 already. Let's move on and look at what happened during the years. During the years, of course, we know that we are going to recognize interest expense for the liability. Now, we started with 49,599, just in case if you forgot, which is here. We're beginning with this number, right? And we're going to pay 10K, 12, 14, 10, 10 respectively. So the way we work out the interest expenses is we take the incremental borrowing rates and then we multiply by the opening to get the interest expense, and then we pay the payment, and then we have the figures carry forward, and then so on and so forth. We do the next year, and by the end of the year 5, the liability should be 0. Okay, and we know that the sum of all the payments minus the initial value of the liability should be equal to your total interest expenses, 6401. This is just to make sure that we know how to derive the total figures, right, as a control, right, if you like. But in terms of the entry for this 5 years, for the end of the year 1, we're going to have the interest expense, debit the interest expense of 2101, and then of course we would in fact credit the bank of 10,000, and then the balancing figure is on lease liability. So this number debit is on lease liability. And does it make sense to have a debit? Yes, indeed. As you can see, it started with 49,599, and at the end of the year 5, all lease liability would be settled. So that's why debit. And at the same time, remember, when you use this asset for 1 year, you will charge depreciation. And in this case, we know that we have a title transfer of this asset. So the asset will belong to H, the lessee, after year 5. And then from that point onwards, H can use the asset for another 2 years until the end of the useful life in 7 years. So that's how we derive the figures for the depreciation. So we ticked the initial figure of the right of use of asset 59,099. We've used it, we've determined it previously. Let me show it to you again, which is here, 59,099. And then we go to that page again. So we take that number divided by 7, and then we have 8,443 for the depreciations expense. And the same thing happened in year 2. So we do the same thing. We worked out the interest expenses to be 1,766, right? And then compare with the payment, or if you like, the rental payment or rental pay. It should be rental pay rather than interest pay, doesn't matter. Rental pay 12,000. Then the difference would then be lease liability 10234. So I think the reasons I use interest pay is this is more like a bond anyway. Depreciation, same amount, and then we repeat the same cycle. We work out the interest expenses 1333 and compare with the payment 14,000. The difference, the balancing figure, would be lease liability. Now, let me show you the working here so that you can follow. Basically, we started with 49,599. In the year 1, we minus the liability by 7,899. Where do we show this? It's in here. This number. Year 1 reduced by this. In year 2, we reduce the liability by 10234. This is exactly what I did here. And then we multiply that with the interest rate. Remember, you don't need to prepare that table. You can work out the interest expenses straight away. Okay, depreciation, the same figure. And then year 4 and 5, repeating exactly the same entries. Okay, by then, right, by the end of year 5, your liability should now be 0. So there won't be further entry on the liability side of it. But what happened to your right of use of assets? Well, remember, you have charged all the depreciations over the 5 years, then you should have an accumulative depreciation left. That would be equal to 5 years of the depreciation expense altogether. But at the same time, you also have the right of use of asset, the cost side, right? So these two have to be eliminated. How come it has to be eliminated? I thought that the asset would belongs to the lessee after year 5. Yes, indeed, we still have to eliminate the right of use of asset because we're going to recognize a new term for it, which is PPE. Okay, it's no longer a right of use, but in fact, the ownership transfer, it belongs to the of course the lessees now. So remember, right of use of asset, the cost is fixed, right from the beginning, $59,099. 5 years of depreciation altogether, you eliminate 42215, the difference becomes your PPE. So the difference becomes your PPE hyphen equipment for 16,884. And then after this year, right, which means after year 5, the lessees can use this asset for another 2 years. So by then, we would use this number divided by 2 to prepare depreciation entry for year 6 and 7. Okay? So let's have a quick look of what happened on the statements of the profit and loss as well as statements of financial position. I've listed out the rental payment here, as well as listed out the interest expense we have charged so far and the depreciation expenses, right? As well as on the face of the statements of the financial position, we have PPE and lease liability. Now, notice that the sum of the interest expenses and the depreciation is here produced with the title total P&L effect. It is bigger each year, bigger from the very beginning, and then drops over the years. Okay, and so as you would expect, the right of use of asset would drops, and so as the liability would drops. Now think about that. Do you think this standard would be welcomed by the lessee, or will not be welcomed by the lessees? Well, the answer is obviously the lessee doesn't like this standard very much. Why? Well, because before we have Hong Kong FRS 16, lessees often have a choice to decide not to recognize the right of use of asset. They can still have rental expenses each year, right? And then they will treat it basically as an expense, just like what you've learned in FA. They debit rental expense and credit bank. Now, you can see that, right? In fact, after they have adopting Hong Kong FRS 16, they are going to have assets and liability at the same time, but then they are going to have more expenses at the very beginning of the lease term and then getting smaller. What will be the effect? Why they so hate this standard? Remember back in FA, in roughly week 12 or 13, you've learned a topic on financial statement analysis. And I'm sure you remember that, right? You've learned 2 specific ratio or categories of ratios. One is the debt over equity ratios. In the case of lessees, once Hong Kong FRS 16 is applied, you can see that the debt over equity ratio would then be big now, because before that you don't have a liability so big. All right, you just debit the bank payment, rental expenses, and credit the bank, or even if you haven't paid for it, you would have 1 year payment as a liability. But now you have a very big liability. What does it mean? It means debt over equity is high, and that means it implies the company is more risky. That is bad news. Bad news number 1. Some of you would then say, well, it's not that bad because we have a bigger assets. Before that, we don't have an asset. Yes, indeed, we have an asset, but we also have high debts compared to equity ratios. And at the same time, we may also have a problem on our profitability ratios as well, because you can see we tend to charge more expenses at the very beginning and then down in the row during the lease term. So that means profitability would now be dropping at the beginning of the lease. So profit drops as compared to either equity or assets. That is not going to be a good sign to the company. Okay, so you can see that they don't like it. All right, now you can then see it, right? In fact, I will show you a little bit of analysis here, right? You can then see, in fact, the total rental payment is 66,000. So the sum of all of that, right? That's cash flows. We also remember receive an incentive of 500, which means the total outflow of the cash is 65,500. That would be cash flow wise, a net outflow of 65,500. It's like, think about it in the way of if you credit the bank. Okay, you credit the bank for that much. What do you debit? Well, you debit overall total depreciation charge, which will be the asset, right of use of asset, times 5 years over 7 plus all the total interest expense together, right? That will gives you the sum of the 5 numbers here equal to 48,616 plus eventually you're going to receive an asset. It's like you debit the PPE, debit all the expenses, right? So the two would then be balanced. I mean, the asset that you receive and the expenses that you recognize. So they are both, remember, on the debit side, right? The sum of that will be equal to the outflow. So this is just to show you that in fact everything that you report on the financial statement reflected by your rental payment. Okay, and you may notice that we did one more thing here, which is for the liability part. These liability, we have to split them up in terms of those that would be payable within 1 year and that would be used or payable in more than 1 year. So let's take a look at year 1 balances of your lease liability. That was equal to 41,700, right? Which is this figure here in the table. Right, if you want to work out of this number, how many of them will be current, how many of them will be non-current. Now before you have to know it, you have to understand the meaning, right? Current means it will be settled within the next 12 years. And non-current, it means that it will be settled more than the next year. Okay, so taking this number 41700, it would be the balance of the liability for the coming from 2 to year 5. And then if you look at the year 2 balances, that would be the balance of your liability for year 3 to 5 onwards altogether. So if you subtract this 2, that would means that would be equivalent to 10234. That would means that in fact out of the 41700, that part would be settled within the next 12 months, and the balance, in fact this number, will represent the non-current part. Is it easy? Well, let's go through one more, make sure you can do it. Let's look at the balance of year 2. The balance of year 2 is 31466. Okay, 1 year later, right, that means after you settle some of the payments, the balance is 18799. That means that represents non-current. And the difference between these two is in fact current. Okay, and so on and so forth, we apply this in this way. Okay, better understand now, and you can see the impact and why lessee doesn't like this single lease model for lessee.